All right. What is up, traders? What's up, tycoons? Super excited for today's video. Lots to show you guys. Okay, we're actually going to dive into a little bit of my secret sauce, right? There's a lot of things that I use to help understand the market movements, understand market direction, and there's lots of leading indicators you can look at, right? I like to say that price action is king. All right, we do a lot of fundamental and economic and macro data in my videos, but I really want to share this with you guys. So please be sure to smash the like button, subscribe to the channel if you guys are new. And the first thing we're going to take a look at here is TLT and SPX. Now, the reason we do this is because TLT, really since 2022 has been a leading indicator for the stock market. Now, what do I mean by that? Well, take a look how TLT on top here is making lower highs, while the S&P 500 is making higher highs at the same time period. So if we're saying that TLT is going to be a leading indicator, then this would indicate that the S&P 500 should be due for a drop. And sure enough, we see that correction and we get a nice little drop in the S&P 500. And here recently, yet again, that has happened where we had this trend here in the TLT where we're continuing to make lower highs while the S&P 500 is continuing to make higher highs. So we're seeing this divergence. And if TLT is a leading indicator, it could show us that the S&P 500 is due for a pullback. And that's exactly what we've gotten. Now, currently at the moment, I'm not seeing really any divergences, right? We're making lower lows here. We're making lower lows. We're trying to start a new trend of higher lows in both of these. So we'll have to monitor this for any potential signals in the future. But this is something that I think you guys should start using. Now, for the NASDAQ, I like to look at the TIPS ETF, right? So this is Treasury Inflation Protected Securities on top. And then we have the NASDAQ right here, the NDX. So again, you can see the same thing where we're making these lower highs, all right? We're making these higher highs. And, if TIPS is going to be a leading indicator for the NASDAQ, then we should see some type of a pullback in the NASDAQ due to the fact that we're making these lower highs. And sure enough, that's exactly what we get. Over here, we're making these higher highs. Over here, making these lower highs. Should get some type of a pullback in the NASDAQ. And sure enough, we get a pullback in the NASDAQ. Now, what's really interesting about a lot of these bond ETFs, right? The TIPS actually just broke through its lows, right? The market bottomed around October. The NASDAQ bottomed around January. But the S&P 500, if we go back to that in TLT, you can see really what we're looking at here is the bond market has gone nowhere, right? It's gone completely nowhere since the market bottomed. You can see the S&P 500 bottomed here in October, TLT bottomed here in October, and is very close to retesting the low. So, the bond market has pretty much gone exactly nowhere, essentially. Meanwhile, the S&P 500 and the NASDAQ are rallying. Now, those are two of my, kind of like my little internals that I like to look at. All right, or some of the leading indicators that I like to look at. Another one that I really like to look at is to determine if the market is going risk on versus risk off. So what we'll do is we're going to pull up our next chart here. And what we have is the S&P 500. We have the biotech sector here on the bottom. And then we have a ratio chart here. This is XLY divided by XLP. Now, what are we using this for? And why am I talking about risk on versus risk off? Well, the biotech sector is arguably one of the most risk on asset classes in the stock market. These are profitless companies oftentimes that people are investing in, hoping that they, have a breakthrough with a drug or some type of product to get an FDA approval, and then they start to make profit. So, arguably it's one of the most risk-on sectors in the market. You have the staples or you have the discretionaries divided by staples. Staples are often seen as a flight to safety, as a defensive play. So whenever this is going down, this means that staples are outperforming discretionaries. And when this goes up, it means that discretionaries are outperforming staples. So whenever you see this chart to go down, it means that investors essentially are going risk off and they're, retreating to safety, retreating to defensive stocks, retreating to staples. And then we have the S&P 500 here on top. So take a look how the S&P 500 went completely nowhere from January 30th to about May 15th, really went nowhere, right? We actually got a pullback and then we weren't able to break out until we had the breakout in XBI and then the breakout in the discretionary to staples chart, right? So, we got the break of trend here. We started to signify an uptrend. This kind of showed us that the market was going more risk on, right? And you can see at this period, this is when the market is actually coming up, but it wasn't able to break out past the previous highs until we actually broke out on the staples to or on the discretionary to staples ratio chart. you can see, here's our first breakout, start to gain some momentum. Here's the second breakout, and now we start a new bullish cycle and make new highs. So currently, we're seeing this downtrend here in these discretionary to staples chart. But things like Tesla have actually been performing a little bit better in the more recent days, right? And so we actually got a breakout and a retest here. So we've started to break out. The market is trying to go a little bit more risk on. We did have Jackson Hole here recently. And that's kind of why we've been seeing the market go a little bit risk off. The XBI, all right, has actually broken its more recent downtrend. The combination of these two trend lines right here is actually a chart pattern known as an inverse bump and run. And if it were to play out, right, we would break out past the second trend line and see a sharp move up back towards these highs over here. Now, there's no guarantees that this chart pattern would play out, but at the moment, it's really just two trend lines. So there's a couple ways to look at it right now, right? We can see that the S&P 500 is very close to breaking out. If this were to go back down and this is to be a look above and fail, then most likely we're going to see the S&P 500 continue to trend lower. But if this is it right here and we're getting the breakout that we need, right, it's very possible we could see the S&P 500 start to break out, but we really need the biotech sector to come back out. That's when we would be able to take out our new highs, right? So if we were to just simply draw a horizontal line here, we could get, the breakout here on the discretionary to staples, and that could take us up towards our previous highs. But until we start to see the biotech sector break out as well, that's when the market's really going to be risk on again. And that's when we would be breaking through right around that 4,600 level on the SPX. So we need to monitor these, right? We want to see confluence and congruence, in these charts, right? And in some of these different ways of looking at the market. Now, another one that I like to use is going to be the Dow Jones, right? If you know about the Dow Jones theory, to see the market creating new highs, right, you should see the industrials, right, and the transportation average, pushing up higher as well, right? That lets you know that it's a real rally because, these are the companies, right, that are transporting all of the goods across America. And then the industrial, the Dow Jones Industrials is the companies manufacturing all of these goods. So you want to see these leading the way as well, right? If you see these not rallying, the Dow Jones Transportation and the Dow Jones Industrial, but you see the S&P 500 rallying, then that might not be such a good sign. And you can see here that the Dow Jones Industrial average is very close to making its, hitting its previous all-time highs. The transportation average also got very close to hitting its previous all-time highs. So, we're seeing a lot of confluence here, right? So this rally that we had and this bottom that we put in October, it was valid, right? This is some of the ways that you can tell, whether or not something is a bear market rally, and whether, it's a real rally or not. So, ultimately for the S&P 500 to make new highs and, new all-time highs, but at the moment for new highs, we need to see the industrial average break back above its previous resistance here. We need to see the transportation average also break back above its previous resistance level here. You can see that these two are actually going down, right? If we were to zoom in just a little bit more on these, right? And we'll do that right now, just so you can see a little bit clearer what it is that I'm trying to explain. So take a look how the S&P 500 is making these higher highs in the previous week, right? It's starting to go up, right? It's like uptrend. Well, the transportation average is going down here. We're also seeing the industrial average going down here, right? We saw when we look at the XBI chart that biotech is trying to break out, but it hasn't really gotten this full breakout that we're looking for. So what we need to see if market is really going to go bullish again is we need to see the transportation average pick up, right? We need to see the industrial average pick back up again. We can't have just the S&P 500 rallying right here and these two not performing as well, right? That's a warning sign basically you want to look out for. Okay, and if we go to the four pillars right here, and this is going to be your XLK and SMH, on the top, and then we have the XLI and the XHB. So XLI is your industrial sector, XHB is your home builders ETF. All right, we have SMH right here. This is your semiconductor ETF, and then you have the XLK right here as well. And so, semiconductors are a big building block of the tech sector, right? And home builders are a big part of the, in XLI, industrial sector, right? So you want to see these asset classes, and look at these and, seeing these and how these are performing can also give you clues into how the S&P 500 or the NASDAQ are going to perform. And if we were to take a look, these are all just trapped in overhead supply, right? It's very, clean, clear to see, right? We have, overhead supply, we have overhead supply, right? We have overhead supply, and we have overhead supply. So, right now we're stuck between overhead supply and support below, right? Support below, support below, and support below. So currently, it's very possible we're going to stay in this environment where we really just trade within these ranges, right? And that's something that I'm taking as a real possibility, right? We continue to just zigzag in between here, between overhead supply and support, between overhead supply and support, between overhead supply and support, until we really get some clear direction. Right. And that's why we're using some of these other charts here and different strategies to tell us, are we going to see, breakouts to the downside? Okay. Breaks to the downside, breaks to the downside, breaks to the downside. This is what the bears are going to tell you, right? And if the bears want to have their thesis supported, then they need to see this breakout to the downside. Right. The bulls, for the S&P 500 to be making new highs, these things, they need to break out above that overhead supply, retest, and push up higher, right? Breakout, retest, push up higher. Breakout, retest, push up higher. These are a lot of the things that I'm using. Now, I do want to give a quick shameless plug to my newsletter. All right. It's called Investment Intelligence. And it's completely free to you guys. So if you guys are fans of just general investment intelligence and also some free trade ideas, I highly recommend checking it out. Right. These are going to come straight to your inbox. So you don't have to go out looking for these. All right. These are going to come straight to you, and lots of good information in there. And then we also go over some charts, different things that I'm looking at in the market in each one. Right. We talk about treasury yields. We talk about commodities. We talk about stocks. We talk about, value versus growth, many different things. And, I really would appreciate it if you guys would sign up for this, trying to grow this here currently at the moment. There's a link in the description, also in the comment section down below. And it would really, help me out a lot if you guys would sign up for this. Okay. So anyways, let's go back to our charts here. And we talked about the four pillars being stuck between overhead supply and support down below. What's something else that we can look at to try to get a sense of the market? Well, one thing that I like to look at is the percentage of stocks above their 200-day moving average and also their 50-day moving average. So that's what we're going to dive into next here. All right. Let me go ahead and zoom in on these charts a little bit for you guys, so it's a little bit clearer. And again, divergences and divergence trading can be very useful and beneficial. Take a look how we're essentially in this downtrend here, but the percentage of stocks above their 200-day moving average is starting to actually trend higher. So more stocks are getting above their 200-day moving average as the S&P is pulling back at this moment. And what do we see? We end up seeing it led to a nice rally. You see the same thing here on the percentage of stocks trading above their 50-day moving average. And another time this happened in October. Okay, so really kind of like when the market was trying to bottom, essentially. That's when we saw this here. All right, that the S&P is making lower lows, but meanwhile, percentage of stocks above their 200-day moving average, percentage of stocks above their 50-day moving average is actually increasing up higher. Let me make this chart a little bit more visible for you guys. And I do have some levels on here too. These shaded areas on the chart. These are areas when it's potentially a good time to buy and sell, based on the percentage of stocks above their 50-day and 200-day moving average, right? If you see, we came down into this range here, and then that's right around here on the S&P 500, nice rally upwards. And then, you can see over here, percentage of stocks above their 50-day moving average was over 90%, right around 94%. You end up seeing a slight little pullback in the market there as well afterwards. So just, again, some more of the little internals that I like to use. So if we look currently, the percentage of stocks above their 50-day moving average is only at about 30%. So is that screaming bullish to you at the moment. Not necessarily, right? It's definitely not short-term bullish. We've definitely seen a pullback here in the market. And so we can clearly tell that, hey, the trend has been bearish, right? We're not really seeing any divergences here at the moment. And if you take a look at the percentage of stocks above their 50-day moving average, this is at 0.5. So this means 50% of the companies in the S&P are trading above their 200-day moving average. For you to be bullish for the market to be bullish, this needs to be above 50. It's just that simple, right? Look how as soon as we cross down below, the first moment that we cross down below also coincides essentially with the top of the market. And then we, have these little areas where we try to get back above, right? And these are bear market rallies, but ultimately we fall back down below and we continue heading lower until we get the percentage of stocks above their 50-day or 200-day moving average back above 50%. Right, we had the initial divergence that propelled us up higher to get above 50%. And then we had a pullback here, but notice how we stayed right along that 50% level here. We started to move back up. We saw another pullback here in the market. And you can see that this is really useful and helpful, right? Once we get above the percentage of stocks above their 50% on the percentage of stocks above their 200-day moving average, that's when we start to see real momentum, right? And when we're below it, that's when we start to see momentum to the downside as well. So, the bulls, they're going to be looking for this to get above 50%. The bears are going to tell you that this is going to go below 50%. And if that goes below 50%, then you're going to see the S&P 500 most likely continue in a downtrend. Let's take a look at, something else I like to look at. This is the skew, and this is the S&P 500. So the skew is kind of like your, it's essentially your oh shit indicator, right? When you see this, skyrocketing upwards, oftentimes that means that there's a panic in the market. And that's a time when a lot of people are panicking and pricing in huge type of downside, right? So these tend to almost mirror the S&P 500. And that may seem backwards given the way that the indicator is set up, but what it is people are, when you see this, pushing up higher, right? People are pricing in, okay, well, hey, there could be some type of a pullback, right? And they're pricing in some type of a, basically large pullback, right? These are out of the money options. These are out of the money put options, right? So pricing in some type of a drop. And you can see that, once we hit our peak here in the skew, okay, and I have 3 levels here, and anytime we're around these levels, this is when I start paying attention for a short-term pullback in the market. And we can see we came up to our levels here, and we've started to see the decline in this, and we've also started to see the decline in the market, right? So this isn't going to necessarily go up while the market is already dropping. You can see over here, you see it's in this clear downtrend, and you see the market is in this clear downtrend as well. Now there's some very good buying opportunities also based on this chart, right? If you take a look, I have essentially this demand zone, and anytime we come down into this zone, this is going to be a very good opportunity, right? I've highlighted it with arrows on the S&P 500, but we dip back down below it into here, and a few times over the years, we've come down into this area and into this zone, and those have been really good long-term buying opportunities. So I'm always looking to see if the skew is going to come down to these levels. If it does, then I'm going to be very interested. But again, you can see here, basically straight up, basically straight up, basically straight up, straight up, and then there are these pullbacks, right? These pullbacks, and that's when it comes back down into this range on the skew, and each one of those was a dip buying opportunity for another rally upwards. All right, same thing over here in more recent time. We came down to those levels in October. That's when we basically retested the lows on the skew, got very close to those lows, and then we started a rally. Then we had a strong pullback. And what did we do? We came back down into that zone, and we've pushed up higher ever since. So, these are more things that I'm looking at to be cautious of, right? When skew is above these levels and at these elevated levels, it just means that there is a possibility we could see some type of a pullback. Let's see if there's anything else in here I can go over with you guys. I think we went over most of the things in here. This is the XLI, NDX, SPX. kind of just going over that Dow Jones theory that we talked about earlier, but just another way of looking at it with the XLI Industrials ETF and the NASDAQ 100 and the S&P 500. We can see the S&P 500 is close to breaking out here at the moment. Meanwhile, the NASDAQ is not really close to breaking out, and the industrials is not, well, the industrials are closer to breaking out. So, we really need to see the Qs catch up. We need to see the NASDAQ catch up in momentum, and we need to see industrials break out. If we can do that and get a breakout in the S&P 500, then most likely we're going to come and retest the highs. But, if we just only get a breakout here in the S&P 500 and we don't get any follow through in the NASDAQ or the industrials average, then that could tell you it's a little bit of a false breakout, or not necessarily a true rally, and more of a dead cat bounce, and potentially more room to come to the downside in the S&P 500. If we were to take a look at Bitcoin real quick and just take a look at that, you can see Bitcoin has fallen to levels we really haven't seen in a while. It's been a good little while since we've come and tested these levels in Bitcoin. We take a look at the NASDAQ. If we were to just go over some key levels on the NASDAQ, we're stuck in range right now between 15,250, 14,650. That's previous highs. You see, we tried to flip that to support, but ultimately we ended up flipping it to resistance. Now, what's important to note here is that we've already tested it as resistance twice, basically. And the more times you test the level, the weaker it's going to get. So, if we continue to test this 15,250 level, it's very possible we see a breakout to the upside. Now, we've also tested 14,650 multiple times as well, right? It's previous resistance here, support here, support here. If we break 14,650, then we're going to be looking at downside. And then we have the S&P 500 here, just again, kind of showing you guys. Let me see here. I think this is actually on the wrong drawing set. So the S&P, right, we, had previous highs here around 44.50, right? We broke down through those levels, retested it as resistance. If we were to break through those levels, it's very possible we come back down to the 4,200 area, right? So hopefully you guys enjoyed today's video. It's a little bit different, right? We're actually on my Thinkorswim right now, which is really my main charting platform. Oftentimes I use TradingView, for my YouTube videos, because it's very simpler, it's very beginner friendly, and it's a little bit easier and to see things. But when I really like to get complex and into the nitty gritty and really analyze markets the way that I really want to analyze them, I love to come over to Thinkorswim, and that's what we're looking at here. Hopefully you guys enjoyed today's video. Smash that like button, subscribe to the channel. Don't forget to sign up for that free newsletter where you can get content like this and more delivered straight to your inbox every single week, completely for free.